Okay, so picture this. You're in OYO's boardroom. A massive IPO is on the horizon. But before anyone can even think about ringing that opening bell, there's a huge problem to solve. The company's entire future, its core business model, is up for debate, and the clock is ticking. Let's break down this billion-dollar balancing act.
So here's the deal for the leadership team. They've got a crystal clear 12-month mandate. They have to prove to the public markets that their business model isn't just a one-off success. They need to show that the economics are solid, repeatable, and can scale from one city to the next. No pressure, right?
And this pressure is coming right after a huge win. I mean, in fiscal year 2024, OYO did something for the first time ever. They reported an annual profit, a whopping 229 crore rupees. It was this massive turnaround that suddenly made an IPO feel totally inevitable.
And the good news just kept coming. The very next year, fiscal year 2025, that profit more than doubled to 623 crore rupees. I mean, talk about a comeback story. This is what got everyone seriously talking about an IPO again. But to really get the choice they're facing now, we've got to rewind and see how they got here in the first place.
Yeah, to really understand the fork in the road they're at today, we need to do a quick trip back in time to see their journey from a simple idea to a global giant and then all the way back from the brink of collapse.
You know, it's a classic startup roller coaster. It all started back in 2013 with a really simple idea, what we'd call an MVP. One single hotel promising a predictable, standardized stay. Then, SoftBank came in with a ton of cash, and they went into what's called blitzscaling, just hypergrowth no matter the cost. By 2019, they were everywhere. And then, 2020 happened. The pandemic forced this massive, painful reset that ultimately paved the way for the profitable company we see today.
And when I say that reset was painful, I mean it. This quote from the founder Ritesh Agarwal and an internal letter, it says everything. It was a really blunt public signal that the whole growth at all costs party was over. The new game was all about feasibility.
Which brings us right back to today's core problem. After surviving that near-death experience, OYO is facing a fundamental choice about its future. It's a true fork in the road.
And this slide right here, it just perfectly captures the tension. On one side, you've got the asset-light franchise model. And look at the pros. Low cash up front, low risk from fixed costs, and you can scale it up super fast. The catch? You have less control over quality. Then, on the other side, you have the leased properties. Here, you get total control over quality, which is amazing for the brand. But it costs a fortune, and you're stuck with huge fixed costs. It's that classic battle. Do you want to be agile, or do you want to be in control?
So, and this is the crucial part, this isn't just some philosophical debate they're having. The whole decision is driven by the numbers. And those numbers, they change dramatically depending on what city you're in.
Okay, and before we jump into the math, just a quick but really important note. What you're about to see is a hypothetical scenario from the source material. It's designed to really push these models to their limits. These are not official OYO numbers, but they do a brilliant job of showing the economic puzzle they're trying to solve.
All right, let's break this down. The key number to look at here is RevPAR. That's revenue per available room. You can see right away that in a big Tier 1 metro city, it's almost double what it is in a smaller town. So, after OYO takes its commission and pays for quality control, you get the net contribution. That's basically OYO's profit per room. And look at that gap. It is huge. This shows that scaling in the wrong market doesn't just add rooms, it actually amplifies how thin your margins are.
And if you want to see the risk of that leased model boiled down to a single number, here it is. Based on the assumptions in this scenario, a leased hotel in a smaller Tier 2 or 3 city would need a 61% occupancy rate just to break even. And if the average is only 55%, well, you can see how this model becomes a financial track, and fast.
So all this math forces a much bigger question. It's not just about adding more hotels. It's about building a real, sustainable advantage. So what is OYO's defensible wedge? What's the thing that their competitors just can't copy?
And the answer isn't just about having a famous brand or the most hotels. The real defensible wedge is in the routines. It's the boring stuff. It's the city-specific playbooks, the data that helps them price things just right, and the relentless day-in, day-out grind of consistent quality control. That whole system, when it works, it's incredibly hard for anyone else to replicate at scale.
So, after this deep dive into OYO's billion-dollar balancing act, what are the big takeaways? Let's boil it all down to 3 crucial points.
So here's the playbook. First up, feasibility is way more important than footprint. The math for each city has to work, because just getting bigger only magnifies the good or the bad.
Second, real defensibility is in the routines. Look, anyone can sign up more hotels. It's way harder to copy a system that delivers consistent quality and pays owners on time. And third, the choice of model has to be contextual. A leased hotel might be a brilliant anchor property in a busy part of Mumbai, but it could be a financial death trap in a smaller city. There is no one-size-fits-all answer here.
So, let's go back to that boardroom. You've seen the history, you've seen the numbers, you get the trade-offs. The final question, well, it's a challenge for you.
If you had 12 months on the clock, what would your plan be? Would you go all in on the asset-light franchise model? Or maybe add a few leased anchor hotels to control the brand experience? Or would you try to build a hybrid playbook, custom for every single city? The choice you make could decide if this incredible comeback story is finally ready for the public market.